You're standing in a store, holding something you've bought dozens of times before, but this time, the price feels different. You pause, because you remember it being cheaper, and you wait, almost expecting it to go back down someday. But it never does. If that feels familiar, this matters, because prices are not designed to fall. They are designed to stay where they are or go higher. To understand why, we need to look beyond inflation itself. Most people think inflation is temporary. Prices go up and then eventually come back down. But that's not how the system works. Inflation is not just a moment, it's a reset. When prices rise, everything around them adjusts. Businesses increase prices to protect margins. Workers demand higher wages to keep up. Suppliers raise their costs to match demand. And slowly, the entire system shifts upward together. This new level becomes the baseline, and once a baseline moves, it rarely moves back. This phenomenon is called price stickiness. Prices are flexible going up, but resistant when going down. Let's make this real with a historical example. In the 1970s, inflation surged across the United States. Oil prices rose sharply. Food prices increased. Everyday goods became more expensive. Eventually, inflation slowed, but prices didn't return to previous levels. Instead, they stabilized at a higher point. The system had already adjusted. Wages had increased. Contracts were renegotiated. Businesses restructured their pricing, and there was no incentive to reverse it. This pattern repeats again and again. Prices jump, the system adapts, and the new level becomes permanent. Now, let's look at the deeper mechanism. When inflation pushes prices up, it increases costs across the board. Labor becomes more expensive. Rent increases. Raw materials cost more. These costs don't simply reverse. They become embedded into the system. So even if demand slows, businesses can't easily lower prices because their cost structure is already higher. But economics is only part of the story. Psychology plays a role too. When prices rise suddenly, people react emotionally. It feels unfair. It feels noticeable. But over time, something changes. People adapt. The new price becomes familiar. This is called adaptation. Your brain resets its expectations. What once felt expensive now feels normal. And once something feels normal, it stops being questioned, which means businesses have no pressure to lower it. There's another layer most people miss: incentives. Businesses are not rewarded for lowering prices. They are rewarded for maintaining margins. Lower prices mean lower profit. Higher prices mean higher stability. So unless competition forces a reduction, prices stay exactly where they are. Now imagine a simple scenario. Two companies sell the same product. Both raise prices during inflation. Inflation slows, but neither company lowers prices. Why would they? Customers are still buying, costs are still elevated, and profits are stronger. Lowering prices would only reduce earnings, so prices remain. This creates a one-direction system. Prices move up quickly and come down slowly, if at all. Over time, this leads to something important. Purchasing power declines. Your income might stay the same, but your money buys less. This is why things feel more expensive, even when inflation is under control. So how do you protect yourself? First, stop expecting prices to fall. That expectation keeps you reactive. Second, focus on growing income over time, because income must outpace inflation. Third, own assets. Assets tend to rise with inflation. Cash does not. And finally, understand the system, because once you understand it, you stop being surprised by it and start positioning yourself within it. The biggest shift is this: stop asking when prices will go back down. Start asking how to stay ahead of them. Because once prices move up, the system is designed to keep them there. And when you truly understand that, you stop waiting for relief. and start building resilience. Money isn't just numbers, it's behavior, it's incentives, it's structure. And once you see the structure, you make better decisions. Money, explained.